What is Robinhood rolling options? Robinhood's rolling options strategy is a technique that allows traders to extend or adjust their options positions to avoid expiration or manage risk. It's an advanced approach that involves closing an existing options contract and simultaneously opening a new one with a later expiration date or different strike price. This can be done for both call and put options, and it's especially popular among Robinhood users who want to either defer potential losses or lock in profits without closing their trade entirely. The main advantage of rolling options is the flexibility it offers. Traders who find themselves in a losing position can extend the timeline, giving the underlying asset more time to move favorably. For instance, if a trader holds a call option that is set to expire but expects the stock price to rise in the future, they can roll the call option to a later expiration date. By doing this, they essentially buy more time without immediately realizing a loss. Similarly, rolling put options can help protect against downside risks when holding a stock that might decline in the short term. Another benefit of rolling options is the ability to adjust the strike price. If the market conditions have changed significantly since the original trade was placed, rolling the option can allow traders to adjust their strike prices to reflect these new conditions. For instance, if a stock has moved significantly higher, a trader might roll up their call option to a higher strike price to take advantage of the increased value. This is useful for both profit-taking and risk management, enabling traders to capitalize on changing market trends without exiting their position completely. Despite these advantages, rolling options comes with notable drawbacks. One major disadvantage is the additional cost. Each time a trader rolls an option, they incur transaction fees and may also have to pay a premium for the new option. While Robinhood is known for commission-free trading, there are still costs related to the options premium, which can eat into profits or increase losses. Furthermore, rolling a position does not guarantee a better outcome. It simply delays the decision point. If the underlying asset continues to move against the trader, rolling the option repeatedly can lead to mounting losses, exacerbating the financial risk rather than mitigating it. Another risk of rolling options is related to market volatility. The more volatile the market, the more unpredictable the future movement of the underlying asset becomes. In such environments, rolling options might provide temporary relief, but can also lead to larger losses if the market trend remains unfavorable. This is particularly relevant on Robinhood, where many users are newer investors and may not fully understand the complexities of options trading. The simplicity of Robinhood's platform makes options trading accessible, but it can also encourage inexperienced traders to engage in advanced strategies like rolling without fully grasping the potential consequences. The decision to roll an option should be based on a well-thought-out strategy rather than a reaction to market swings. It's important for traders to have a clear understanding of why they are rolling the option, whether it is to give the position more time, adjust to market changes, or take advantage of specific movements in the underlying asset. Without a clear plan, rolling options can quickly turn into a strategy of chasing losses, which is a common pitfall for traders on Robinhood and other platforms. In conclusion, while rolling options on Robinhood can be an effective strategy for extending the duration of a trade or adjusting to changing market conditions, it is not without its risks. The additional costs, potential for increased losses, and complexity of managing roll positions make it a strategy that requires careful consideration and a solid understanding of options mechanics. Traders who are well-versed in options strategies may find rolling useful as a tool for risk management, but novice traders should approach it with caution and a thorough understanding of the potential implications. As Robinhood continues to attract young, tech-savvy traders, it's essential for users to educate themselves on these advanced trading techniques to avoid the pitfalls that come with options trading in volatile markets.